The third quarter of 2015 was dominated by weakness in financial markets, especially equity markets. It started in China in August, where the Chinese stock market came under significant pressure, but soon all emerging markets and developed markets were affected by concerns with the strength of the Chinese recovery and the implications that would have across the globe. The other major highlight of the quarter was the decision of the US Federal Reserve not to raise interest rates from record lows in September. The US economy appears to be on track to normalizing interest rates. The US interest rates have been at 0% since 2009. This is very abnormal. It reflects a misallocation of capital to keep US rates at such low levels. So we all know the Federal Reserve is wanting to normalize interest rates. In other words, bring them to a more long-term level of 2 or 3 or even 4%, which is typically where the risk-free rate stays. So the longer the US interest rates stay at 0, firstly, it indicates it's much more difficult for the economy to actually grow effectively. And secondly, it's creating unintended bubbles, particularly in financial assets. So it was concerning for the market that the Fed felt that global conditions were too weak for it to raise rates by just 25 basis points. And this has resulted in volatility in markets. We've commented for at least the past year that the US Fed can be a source of instability in financial markets. They wait too long for signs of recovery, and then the US economy gets inflation in the system and they have to raise rates aggressively. Or conversely, they move too early and they underestimate the weakness of the economy and stifle any prospect of recovery. We would certainly have hoped that the US Fed would have felt confident enough to start increasing interest rates, because we are concerned that these very low interest rates are distorting the pricing of a number of financial assets, including equity markets. Equity markets remain expensive on valuation grounds, and interest rates remain incredibly low. So going forward, generating inflation-beating returns from these levels will be a challenge. And we think investors need to make sure that their time horizon is sufficiently long for them to be able to tolerate any short-term volatility in the pricing of assets. It's particularly important that investors speak with their financial advisors to ensure that they're appropriately positioned in terms of what they can tolerate in terms of short-term losses. Within our own portfolios, we've positioned ourselves defensively. We're not chasing returns in this environment or chasing yield, and we've been quite cautious about how we allocate capital into the market. The managers that we use are generally reinforcing our views, so they tend to be cautious as well and are not overcommitting capital into chasing returns.